These stocks are trading at the same price they were trading at almost 30 years ago.
Even in this all-time high market, there are still some solid stocks trading at value prices right now.
It's a great business. They mint money. You're only paying 8 times earnings for it.
Whitney Tilson with Stansberry Research shares a list of 5 diversified value stocks.
They generate huge amounts of cash flows. Most people probably haven't heard of it.
It's a look at a well-rounded portfolio with the help of AI that could help you beat Wall Street. Let's dive in. Whitney, so great to have you with us again today. We love hearing from you. And this is a really interesting topic, something a lot of retail investors are learning right now, and that's using the power of AI to help pick stocks. Tell us about the latest research that you've done on how good AI is at actually picking some winners.
Sure. Well, when most people hear about AI and stocks, they think about like buying an AI stock, NVIDIA or something like that. We've done something a little different, which is using the power of AI to help find, great undervalued stocks, great companies, et cetera. So we've actually just launched a brand new product called the New Engine of Wealth, or the New System, NEW. And we just came out with our first issue, and we've used AI to identify 20 great undervalued stocks. It's a portfolio. Each one is a 5% position. And we use both our internal long-time Stansberry score, which rates the companies and stock valuations. But then we've used AI to help build a portfolio. Because, being a successful investor isn't just picking individual stocks, but you've got to build a sensible portfolio that's reasonably diversified. And so that's where the AI comes in to help us do that.
Yeah, we're really excited today. You have 5 names that your AI has picked that are that undervalued, really strong stocks to add to your portfolio. So we're going to run through those 5 names here. But I want to put up that QR code and a link right now if you want to look at the research that Whitney and his team at Stansberry Research have done to really put together a full portfolio of stocks that you can use to really beat the market, because they're all undervalued, really strong success stories here. You can scan the QR code now or click the link that's in the description of this video to get to that link and look at that full portfolio right now. But Whitney, let's get right into the list of the 5 stocks that you have for us today. What's the first company?
Let's start with the one everyone's heard of, McDonald's. It's been one of the great growth stocks of all time, going back more than 50 years. It's one I owned in my hedge fund very profitably for many years. And it is an incredible business. Most people might think of it as, they operate restaurants, but in fact, that's the franchisees. McDonald's is the franchisor, which means it doesn't have to do all the hard work and have a capital-intensive business. It just collects royalty fees off the brand name and the real estate. And, the stock doesn't screen, it's not out of favor. It's near its all-time high, but it's trading at 24 times next year's earnings for a company that has, a global, one of the greatest brand names of all time, because it mints money. And, every year just grinds out a little more growth. And it's got, super high margins consistent with a franchise type business. So, it's the kind of business you can tuck away and own for a long period of time.
Yeah, this is a name everybody is familiar with. And every time the stock comes up, we get some naysayers who say that McDonald's, while it's a good value brand, those are the restaurant chains that are doing well right now, it's not maybe doing the best at keeping up with how AI is working on their orders. We hear complaints from consumers out there who say they have got to figure out how to get their orders correct, how they got to get them out timely, things like that. So is there any of those kind of business issues in that AI growth phase for McDonald's that could be hurting the stock right now?
The stock, like I said, the stock's not really beaten up right now. So it's not a company that, is in the AI crosshairs. In fact, they should be able to use AI for automated ordering, for example, doing taking orders and some of the processes. People are still going to be eating hamburgers, regardless of AI. I will say that, McDonald's, there's inflation out there and people are feeling their pocketbooks and all. McDonald's has always been offered, super high value at a relatively low price point. You can get a good filling meal for yourself or your family. But, companies like McDonald's and Starbucks have been raising prices to keep up with their raising costs. And so, and consumers are pushing back a bit. So I would say that's probably the biggest challenge McDonald's has.
An interesting first company to on this list. Let's move on to the second name.
Sure. Well, let me put another growth stock out there because it's interesting. This list has some traditional growth and some traditional value stocks I'll talk about in a moment. It's a boutique investment bank, Houlihan Lokey. Interesting. Also trading near all-time highs. Stock's been a monstrous winner over time. The ticker is HLI, and most people probably haven't heard of it. I, of course, have, being in the business. Stock's trading about 24 times next year's earnings, so it's not super cheap, but it's an incredible business. They have a very nice niche. And one of the reasons I like it is, the markets are at an all-time high. People are sort of predicting that there could be, an economic a recession of some sort, et cetera. And Houlihan Lokey specializes in handling bankruptcies. So they're a bit of a counter-cyclical play where it's been a great growth stock, does well when the economy is good and all, when traditional investment banking, but they also have a business that benefits if the economy tips over.
So interesting. And yeah, this is the first time we've talked about this stock on the channel. I'm interested with our viewers. If you've heard about it before, let me know in the comments. Curious with this one, Whitney, if there is still a lot of strong growth ahead or if this is more of a slow and steady, kind of a safer play to include in the portfolio.
This is in a different category than McDonald's, for example, I guess I would say, with, just sort of a stalwart, a slow growth, but very steady. Houlihan Lokey's in the investment banking. It could be, a little more volatile, trades at a little bit higher multiple, as it's much smaller, has much greater growth potential. So again, this is what the AI has done with our new system, which is it's designed to build a portfolio that has different profiles, different growth profiles, different industries, because having a sensibly diversified portfolio is really important. And this is what a lot of investors, they own, Meta and Google / Alphabet and NVIDIA, Microsoft, and Apple. And they think they're diversified because they own 5 stocks, but they're all 5 big cap tech stocks. They're not diversified at all. That portfolio, of course, done spectacularly well, but you'd be much better off owning one of the big tech stocks and then McDonald's and a Houlihan Lokey, different size company stocks, different industries that are going to provide you with some diversification if the tech sector goes bad or if AI disrupts, one particular business.
Yeah, really good information for retail investors out there. That diversification is key. So, a really good tip. Let's get on to that third company that you have on this AI list.
Sure. Well, I'm going to put them in together. The third and fourth company are 2 pharmaceutical giants, Pfizer and Merck, which I'm sure people have heard of. They're, legendary companies, have been around for 100 years. What your readers or listeners or viewers here might not realize is these stocks are trading at the same price they were trading at almost 30 years ago. Now, they've been paying out nice dividends over time. The stocks have gone up and down, and these are really beaten up stocks trading at extremely low multiples. Pfizer is trading at 7.7 times next year's earnings, Merck at 8.3 times next year's earnings. And they generate huge amounts of cash flows, making branded, patent-protected pharmaceutical products. It's a fabulous business. Pfizer is paying a 7.2% cash dividend right now. Merck's paying a 4% cash dividend. The question investors have, and the reason they're priced so low, is that it's not clear what their growth prospects look like. And in fact, they have struggled to grow. There's pricing pressure. The government and private payers are pushing back on, for years, these companies just used to be able to raise their prices. And we have drug prices as a result in this country that are much higher than anywhere else in the world, as there should be. I think finally there's some pushback on that. But when you can buy 2 of the bluest of blue chip companies that still just mint cash, even if there's no growth, when you get paid a 4% or 7.2% dividend, these companies are just generate huge amounts of stable cash flow. You don't need a lot of growth. And again, these are the kind of stocks you want to have in your portfolio that balance off, something like McDonald's trading at 3 times the earnings multiple, 24 times instead of 8 times. But this is what a balanced, well diversified, thanks to AI, helping us construct a diversified portfolio.
Yeah, this is such great information. We have so many viewers who are really focused on growth stocks, which everybody wants that next big growth stock that's going to get 100% growth over 3 months' time. That's what every retail investor is looking for. But I think it's important to remember these dividend stocks and the importance of dividends. I think this is the kind of investment education that you are really going to be hitting hard at the conference coming up this next month in October in Las Vegas. Talk about, again, there's an invite to all of our YouTube viewers. I'm going to be there. Whitney's going to be there. A lot of the faces that you see on this channel are all going to be there giving lots of education like this. So Whitney, what can people expect at that event?
Yeah, it's a 3-day conference. I've been going to it for 6 or 7 years now. It's at the fabulous Wynn Hotel in Las Vegas from Monday, Tuesday, Wednesday, October 20th through 22nd. Basically all of the Stansberry research, but all of our affiliates as well. Sort of all the gurus you know and love and have been reading for years, myself included. It's a combination of I'm going to be speaking on a couple different panels, but then also having the stage just me, pitching my couple favorite stock ideas. And honestly, I don't know what they are because we're still a month out and a lot can happen in the markets in a month. So it's always the most timely idea that I come up with, right before the conference. Last year, I recommended Joby Aviation, which is definitely on the more speculative side for something, for a value guy like me. But it makes those electric aircraft that take off like a helicopter and then fly like an airplane, battery powered. And the stock's more than doubled, I think almost tripled since I recommended it last year. So hopefully I and my fellow colleagues will have lots more good ideas and lots of good mingling and socializing as well. It's a really fun event.
Yeah, I'm really looking forward to it. Again, I will be there to interview a lot of these people and the faces that you see here. So you can scan the QR code or click the link. This is a special one where if you want to join us in person and come say hello, we'd love to see you there. There's also an option to attend the event virtually and join and just hear all the great stock ideas and also stock education too. So again, we got that link for you here if you want to join us there. Whitney, let's get to your fifth and final pick on this AI list today.
Sure. Well, this is a company. It's called Allison Transmissions. ALSN is the ticker, and they make transmissions for trucks and other all sorts of vehicles. But they're probably best known for heavy duty trucks. And this is a stock that was beaten up for many years because people felt like with the rise of electric motors don't have transmissions. You're not shifting gears, either automatic or manual transmissions. So this was going to be roadkill. And so we recommended it actually in one of my newsletters a couple years ago at $40 a share or so. And then subsequently doubled to $80. And it turns out the concerns were overblown. Allison sells globally. And yes, electric cars are on the rise, but interestingly, they particularly here in the United States, Allison's main market, the subsidies for electric vehicles are going away. Sales are sort of flatlining. I mean, I'm a big believer in electric vehicles long term, but in the meantime, Allison's minting money. And again, like the drug giants, Pfizer and Merck that I mentioned earlier, Allison's only trading at, let me check my notes here, 0.2 times next year's earnings. So it's really cheap and it's a great business. They have a really nice market position, been around forever. And so they mint money as well. And you're only paying 8 times earnings for it.
Sounds like a great value play right now. And I love this list because it is so diversified. It's got transmission companies, it's got biotech, it's got blue chip stocks and McDonald's, and it's really all over the board. And I think let's talk a little bit about the proven success of this kind of concept in investing, and especially looking at how well AI did in building this list compared to maybe a lot of those investors like Warren Buffett, who kind of had a similar theory on investing. How well is this AI portfolio really going to perform?
We can't promise. We've just launched it, but we've done a lot of back testing. The core, we start with the Stansberry score, which is a combination of capital efficiency, financial strength, valuation, and momentum. It's those four things. That's the first screen, and every stock of the first 20 we recommend as Stansberry score goes from 0 to 100 is at least an 85. And then what we do is we use the AI. Once we take the highest scoring Stansberry score stocks, we then use the AI to build a diversified portfolio that can weather different kinds of markets and doesn't leave you overexposed in any one area. About 30% of the portfolio, 6 of the 20 initial stocks, are actually in the healthcare sector. I mentioned the 2 pharma companies as well. Generally speaking, I was sort of glad to see that because it's an out of favor sector. You've got cheap stocks, but companies, very high quality companies that have high margins, generate lots of cash, et cetera. You've got Philip Morris and Altria, used to be 2 companies, broke up, maker of cigarettes. Again, sort of out of favor sector, but wow, what a profitable business, low earnings multiples. But then you've got some growth stocks like, McDonald's and Houlihan Lokey that I mentioned. So I was really pleased to see what the combination of the Stansberry score and AI spit out. These, as I looked down the list, I was like, yeah, this is a great portfolio.
And again, if you want to take a look at that full portfolio of 20 different stocks that are this unique combination, make sure to scan the QR code now or click the link in the description. You can get that full report right now from Stansberry Research. Whitney, thank you so much for your time today and for sharing these great names and this interesting diversified look at investing with our viewers today.
My pleasure. And I look forward to seeing you at the Stansberry conference next month in Vegas.
Yes, so looking forward to it. Thank you, everyone, for joining us today. I'd love to hear from you in the comments. Are you somebody who likes this kind of value investing, diversified portfolio? Or are you sticking only to those high growth stocks? Let me know which ones you're looking forward to most in the comments. Thanks again for watching, everyone. And as always, happy investing.